Welcome to the SmartKeys podcast. If you're a professional in, well, pretty much any industry today, you know the pace of change in finance has gone from fast to absolutely frantic. So today we're doing a deep dive into the future of fintech. We've pulled some really key strategic insights because, let's be honest, staying informed isn't just about curiosity anymore, it's really about survival.
It truly is. I mean, financial technology has moved so far beyond being a back office utility.
Yeah.
It is arguably the central strategic tool now for navigating global markets, especially with all this economic uncertainty.
Right.
And we're seeing this huge shift in behavior. Something like 56% of consumers are relying more on digital financial tools just to manage that instability they're feeling.
And the investment figures, they just scream urgency. The data shows fintech revenues are set to grow almost 3 times faster than traditional banking between now and 28.
3 times.
That kind of gap, it signals a massive opportunity for sure, and also a massive risk if you fall behind.
And that's the key, isn't it? Our mission today is to cut through all that noise. This deep dive is all about giving you the strategic knowledge, how these trends really impact efficiency, innovation, and at the end of the day, your competitiveness.
Okay, let's unpack this. I want to start with a fascinating structural shift that's happening right now, which is the industry kind of growing up. For a decade, all we heard about was thousands of disruptive startups.
Yes.
But that phase seems to be giving way to something a lot more consolidated.
That's right. It's a classic maturation cycle. The sheer volume of startups it's hit a kind of regulatory and capital wall. Scaling thousands of different fintechs to a big IPO is proving incredibly difficult. The friction, the compliance costs, it's immense.
So all that pressure is driving this huge wave of mergers and acquisitions, especially in payments.
Exactly. So instead of 1,000 little players, you're seeing fewer, but much stronger, much more regulated financial companies emerging from the pack.
So what does that consolidation really mean for, say, a non-financial company?
Well, it means more standardization, maybe more robust products, but also, probably less choice at the low end. These big consolidated players have the capital for next-gen platforms, which sets the stage for the first huge trend that impacts everyone: embedded finance.
And this is where it gets really interesting for anyone listening in retail or e-commerce or even B2B. Embedded finance is basically merging financial services loans, insurance, payments, right, into non-financial platforms.
Exactly. It completely erases the line between shopping, buying, and financing.
It's way beyond just a buy now, pay later button.
Oh, way beyond. Think about a farmer buying seeds and being offered instant crop insurance right there in the agricultural supply software. It transforms a chore, a transaction, into just a seamless, natural part of their workflow.
The market potential here is just staggering. The Sources project, it'll grow from around $200 billion this year to, over $600 billion by 2029?
It's an enormous number. That kind of compound growth, you just can't ignore it.
So the strategic implication is clear.
Absolutely. If you operate any kind of transactional platform, you're sitting on a potential goldmine. You have to be asking, how can we use this to capture more of the customer journey?
And beyond just pure efficiency, we're also seeing investment being driven by purpose. I'm thinking of the powerful push behind ESG, environmental, social, and governance initiatives.
Yes, that's a huge intersection now with finance. You've got two things happening at once. First, investors are demanding it. Startups focused on green solutions are attracting serious capital.
And second?
Second is the implementation. Fintechs are building the tools that help companies actually measure and report their climate commitments in real time. It links a company's financial value directly to, verifiable ethical practices.
So it's shifting from a nice-to-have checklist to a real competitive advantage.
It is. If you have more transparency, lower climate risk, you attract more capital. It's that simple. Ignoring it just isn't viable long term.
That framework really sets the stage for the tech driving it all. Let's shift gears to the engine room. Artificial intelligence. It's not a novelty anymore. It feels like it's an indispensable core function now.
The numbers confirm that. 72% of organizations are already using AI in their finance departments.
72%.
Yeah, and that high adoption is driven by necessity, the sheer volume of data, the complexity. You can't manage it manually.
Okay, but let's get specific. It's one thing to say AI manages data, but what is it actually doing that a human analyst can't?
It's doing two things really well: predictive accuracy and automated compliance.
Okay.
So on the prediction side, AI risk models can spot these really subtle patterns of fraud or credit default that a person would just miss. And then on the compliance side, you have RegTech, which uses machine learning to constantly monitor regulatory changes and automatically flag transactions. That kind of real-time oversight is, well, it's impossible without AI.
So it massively reduces that operational drag. But what's the bottom line here?
Revenue and cost of capital. AI is projected to add a staggering $1 trillion annually to industry revenues.
$1 trillion. Wow.
So firms that embed AI are just lowering their costs and improving their margins. This is why it isn't optional. It's the prerequisite for being competitive.
And looking even further ahead, the sources talk about autonomous financial ecosystems. That sounds very sci-fi.
It's closer than you think. We already have robo-advisors handling complex investments. But we're also talking about AI-driven trading strategies that execute trades instantly based on predictive models. It takes human emotion and reaction time right out of the equation.
And speaking of speed, let's talk about the payment revolution. Real-time payments, or RTP. Instant is becoming the new normal.
It's a huge infrastructure push. In the U.S., you've got FedNow as a key driver, allowing for immediate fund transfers 237.
So what for a business owner listening to this?
It's all about cash flow. Imagine you run a logistics company, and you get paid the second a delivery is made. You can immediately pay your suppliers. You cut your reliance on credit. It just smooths everything out. RTP eliminates that float time, giving you a crystal clear, real-time view of your capital.
And on the consumer side, you see how much people want this. The growth in peer-to-peer payment apps is insane. They were expected to handle over $1 trillion by 2023.
That's a consumer preference that businesses simply have to respond to.
Right. And that movement towards efficiency is also linked to inclusion, which brings us to another huge shift: alternative credit scoring.
This is one of the most powerful democratizing forces in fintech right now.
It addresses a really big problem. You've got, nearly 49 million Americans who are credit invisible, right? They face huge barriers to getting loans.
Precisely. And fintech is closing that gap by using alternative data.
Not just a FICO score.
Not at all. We're talking utility payments, rental history, other transaction data, all analyzed by AI and machine learning. It builds a financial profile where one just didn't exist before.
So that's a huge benefit for the consumer. But for the lenders, does that increase their risk?
You know, it's the opposite. It's a true win-win. For the lenders, looking at this wider, more granular data actually gives them a much clearer picture of financial responsibility. It's been shown to lower default rates.
That's fascinating. So better risk assessment and more inclusion at the same time.
Exactly.
And consumers aren't just changing how they borrow, but how they pay for everything. We are in the middle of a digital wallet tsunami.
We really are. 2/3 of adults worldwide now use digital payments. But the demographics really tell the story. 79% of Gen Z and 67% of millennials are using digital wallets. This isn't a trend, it's a permanent generational shift.
So what does that mean for a traditional bank that's built around physical cards and ATMs?
It's a mandate to transform, and quickly. 30% of all transactions in advanced economies were already cashless last year. If banks don't offer seamless digital experiences that integrate with these wallets, they risk just becoming irrelevant in their customers' daily lives.
With all this data flying around, though, the obvious counter-challenge is security. Cybersecurity isn't just an IT problem anymore.
It's paramount. It's a brand trust issue now. The sources show over half of people say security and privacy are their #1 concern.
And the threats are getting more sophisticated?
Right. AI-powered phishing, attacks on APIs. A single big breach can just wipe out years of brand equity.
So what's the solution? What's becoming the industry standard to maintain that trust?
It really boils down to multi-layered defense. The key is biometric authentication.
Fingerprints, facial recognition.
Exactly. It's a non-replicable physical layer of security. You combine that with multi-factor authentication, and you create a really strong barrier against fraud. That's how you build and keep consumer trust.
Okay, let's pivot to our final segment. Looking forward at the biggest strategic issues: regulation and the new frontier of digital currency.
The regulatory landscape is, it's evolving in real time. It's trying to keep pace with all this innovation while also pushing for stability and transparency.
And this isn't new. Regulators have been trying to get their arms around this for years, right?
Oh, absolutely. You can look back to 2016, the OCC published a paper on responsible innovation. Then in 2017, they proposed special bank charters for fintechs. The history shows this consistent goal: safely integrate these new firms into the financial system while demanding high standards.
And the ESG factor you mentioned earlier, that sustainability push, is just getting stronger.
It is. Adhering to those standards isn't just about compliance anymore. It actively improves your reputation, which, in the digital age, translates directly to your bottom line.
Okay, finally, let's talk about digital assets. The growth is just undeniable. 200 to 300 million people globally own some form of digital asset. The market is expected to triple by 2030.
That trajectory, though, runs right into the strategic plans of governments. And this brings us to the most significant frontier in money itself, central bank digital currencies, or CBDCs.
Right, which are often confused with crypto. For our listeners, how should they distinguish a CBDC?
It's a vital distinction. Unlike cryptocurrencies, which are decentralized, or stablecoins, which are private, a CBDC is a digital form of a country's fiat currency.
So a digital dollar issued and backed by the central bank.
Exactly, it's digital cash, sitting right on the central bank's ledger.
And the implications of that shift are, well, they're huge. They go way beyond just payments.
Fundamentally, CBDCs could transform economic policy and cross-border transactions. They offer a way to do instantaneous secure transfers that bypass the old, slow banking networks. It's a new frontier that signals digital assets are moving from the fringe of finance right to the absolute center.
So when you put this all together, what does this entire deep dive mean for the professional listening right now?
I think the overarching theme is really defined by two words: efficiency and inclusion. And both are completely non-negotiable for success. To stay competitive, you just have to embrace these advancements. Machine learning, big data, embedded finance. These are the tools that let you operate globally, achieve efficiency, and secure loyalty. Ignoring these trends is, well, it's essentially choosing to become obsolete in your field.
That's a very powerful, very actionable summary. So here's a final thought for you to take away from this. Given the rapid acceptance of things like alternative credit scoring and the explosive growth of digital wallets, especially with younger people, how quickly do you predict physical cash will functionally disappear from transactions in major global economies? It's something to mull over. Thank you so much for tuning into the Smart Keys podcast. We hope this exploration provided the strategic knowledge you need to stay ahead. To access the full article, The Future of Fintech, Business Trends to Watch, please check out the link in the show notes. And don't forget to subscribe for more deep dives.